I have been absolutely shocked by how volatile this market has been thanks to geopolitics bringing down actual gross domestic product. We're seeing red flag signals all over the place, yet when it comes to fundamental earnings, things have been improving and actually getting substantially better than so many of us could have expected, which is why I burned so much money on that pit of fire when these stocks were absolutely tanking. And I want to dive into it a little bit more in depthly now that we're recovering, seeing what earnings look like on the Canadian side of the border, considering we should be in a great depression as far as the media would make it out to be. And we're going to talk about two earnings specifically in this video, something that came out in the past I haven't discussed when it comes to Enbridge and of course Manulife. And all of this really plays into my investments, my two biggest ETFs, one of them being VDY, my high yield monthly paying Canadian dividend ETF that I have been collecting some pretty nice checks on. I've got like $400 or $500 received just in the last couple months. I should realistically have this set up on a drip, but when the market was incredibly volatile, I'm like, I want to find some places to put this money if the market keeps going down. And here we sit, markets have recovered. I probably should reset this back up on a drip. I'm averaging about 4.57% or $2,500 annually that's paid out monthly, which has been great. And the payments have actually been quite stable as of recently, still trading toward their highs, which is great. And the S&P 500 is now almost recovered as well, catching back up with the Canadian economy. It's really nice to see both of these market ETFs have been trading quite in line considering how different the investment vehicles are. So it's great having this high yield income, the great capital growth on the back, and then the US more oriented toward growth that have been buying quite heavily on the dips where I've been seeing quite the return in my portfolio, getting me over 400K. I mean, these dips we've been buying around here, whoo, chef's kiss. Thank God I don't listen to the drama and get caught up in the nonsense of people telling you not to buy when the market's going down, because it's always been more favorable to buy. So let's dive into it. The earnings calendar coming up. We have a lot of stocks. Constellation Software is going to be posting tonight. We already had Shopify. Power Canada, or Power Corp of Canada, I should say, that owns Wealthsimple, will be posting tonight. A ton of stocks like Northland Power, a lot of cool stocks. Next week, we're going to be starting to get into the bank earnings with TD and other huge amount of companies like Canada Goose Holdings, things that I'm going to be paying attention to, especially with TD now that banks are trading at relative highs to their price to earnings multiples, more than they statistically have throughout their history. So very excited for the bank earnings, because like Pokemon cards, you do have to collect them all, and it's one of the primary reasons that I buy VDY. I mentioned this on my live stream because everyone's like, oh, do you buy the Canadian banks? Like I said, this is my one basically my end all be all solution to investing in the Canadian markets, for me anyways, because I get all my favorite stocks upper weighted. And when we really want to talk about Enbridge today and Manulife, because they do make up substantial portions of this ETF combined, they're over 12% of this entire ETF. So I am paying attention, right? And I'm going to say I do not understand Manulife all that well. I said I had some concerns with interest rates dropping, that them being a cash rich company making a lot more off interest income that could start to deplete and deteriorate. And Enbridge, on the exact counterpart, should start seeing a recovery on some of their debt because interest rates should start to deplete, and that means their debt should start beginning to get cheaper and cheaper moving forward. But let's talk about Enbridge, I guess. First and foremost here, still holding, flat on the year, which how can you complain when you're getting a 6% yield? But the stock is starting to drop this week, and, with some concerns around oil and energy prices coming down, usually these companies would get hit, but unlike Canadian Natural Resources, which actually did quite well on its earnings because of the continued increase, in energy, supply that they're bringing out of the ground, whether it be natural gas or oil. I was shocked to see that Enbridge posted quite astounding numbers. The stock's still going down this week. Not sure if it's related because the earnings did come out on the 6th and the stock did pop up quite a little bit. So I'm not sure what's bringing the stock down right now, as they're claiming, according to the Seeking Alpha article, that Enbridge earnings justify its current valuation. Enbridge is an 18% year-over-year adjusted EBITDA growth driven by strong operations, favorable currency, and diversified portfolio with a 98% regulated or take or pay contracted EBITDA. The company is expanding its midstream assets, including $3 billion in low-risk projects, significant investments in the Permian Basin, and a 10% equity stake interest in the Matterhorn pipeline. And Enbridge financials are robust, with $5.8 billion in adjusted EBITDA for Q1 and high single-digit DCF yield, supporting a 6% dividend yield. Despite a high debt load, Enbridge's integrated portfolio and strategic positioning in the Permian Basin make it a valuable investment with continued growth potential. And the dividend, I will say, is starting to slow down from its historical growth. I think they're projecting for about a 3% growth moving forward here, so I don't think we're going to see the same huge bumps that we saw in the mid 2015, the 2010 eras. If we take a look at the current dividend scorecard over the last 5 years, we're getting to 4%, but that will likely start to deplete even lower. But again, if you can lock in when this company tanks, get closer to somewhere between that 6 and 8, we're trading around 6 right now. It's nice when you could have locked in that 8 and focus on getting your total return from the dividend, which seems to be one of the most stable Canadian dividend payers out there. That's where you're going to get your real return from. And if you don't know this company, I mean, do I really have to explain to you how this is like the bloodline of the entire Western world? It is the largest pipeline company, I think, in the world for the most part, and in North America, spanning all the way from Alberta down to basically the bottoms of Texas. And they have a lot going on here. I mean, if you just take a look at like even their main liquid pipelines, again, represented in the purple, I mean, it's just insane to see how far this goes. And it's fun to talk about some of their gas transmissions, their natural gas transmissions, because they did a massive purchase, in the United States as of recently for natural gas, making them the largest natural gas powerhouse company basically in North America. You can take a look here on some of the acquisitions with their gas transmission lines, which look to be more toward Texas, gas distribution and storage, which if you're using natural gas in Ontario, go look at the natural gas line outside your house. You'll probably see that it is Enbridge owned. A huge business for them. They got the renewable side, which I don't really care about. Renewable is not growing like it has been in the past, especially with the new administration really cutting back on promoting kind of the renewable sector as much. If we take a look at those earnings, as mentioned, going from 4.95 billion to 5.8 over last year is quite incredible. Liquid growing nicely, gas transmission growing, gas distribution and storage up substantially. Renewable power is the only thing that's down. Elimination and others is down as well. I'm not sure what that relates to particularly, but overall, I don't think anybody's really complaining about Enbridge here. And as mentioned, their dividend growth rate is expected to grow at 3%, DCF at 4%, but total adjusted EBITDA at 9% is nice to see. So overall, this company should give a healthy rate of return. And if we take a look, financing costs continue to be one of the big down factors, increased due to higher rates and debt balances. I noticed they bring this up quite a lot, but this should start to alleviate, I imagine, heading through 2025 into 2026. Overall, the company is trading the dividend yield, again, not as attractive as when we're getting closer to those 8%, but it is starting to come down, but still in the upper ends that we've seen throughout its history, especially in the last 5 years. Revenue and profits, again, starting to recover here. So the company is into a new phase of growth, but again, mostly driven by acquisitions, new pipelines coming into play. So they still have a nice, I'm going to say pipeline kind of coming down the road for their growth. Overall, I do love this company with the exception of the outstanding shares that they use, I think, to make some of those acquisitions. They did do some dilution that was pretty heavy on the stock. To see a 4 or 5% dilution like we've been seeing here has been quite hefty, but I think it's starting to alleviate, so it's something that we hopefully don't see too much of moving forward, because in comparable to Manulife, company yielding 4%, a lot of people like this, and it is popping up on its earnings, which came as a bit of a shock to me, and I don't know how to value these kind of companies. They're a bit more perplexing to me. The dividend growth has been astounding. I mean, from 16 cents to 40, it's been one of the greatest dividend growth companies in Canada. Right now, the company's been growing at over 5 years at a 10% clip, which is insane. Getting a 10% growth rate on your dividend is insane, with the current payout ratio being as low as it is. But what I really want to point out here is their core earnings have been absolute trash. If you take a look, I mean, I was shocked at how bad these earnings were for this company, and the stock still went up because their net income attributed to shareholders was down 47%, EPS down 48%. But what really perplexes me is when you kind of look at the book value of this company, because book value per share went up to $25.88, which was up 12%. And I'm not sure if this comes from current clients or how you value Manulife. I mean, what's the stock currently trading at? 44. Like I said, I am so confused because when I read into the statements, our underlying business growth remained resilient, while our core EPS growth was dampened by strengthened provisions related to expected credit losses and provisions for the California wildfires. Book value per common share continued to increase steadily in Q1, growing by 12% year over year. We maintained a strong LICAT ratio of 137%, and our financial leverage ratio was 23.9, well within our medium-term target of 25%, anchored by our strategic priorities and supported by a robust balance sheet. We are well positioned to navigate the current economic conditions and capitalize on growth opportunities. I do not understand financial companies at all when it comes to insurance players. So I'd love to know what you guys think about the earnings, and do they justify the growth? I'm probably missing something. I have to do a little bit more homework because I just took a brief look at it. And clearly you cannot judge a financial company or an insurance financial company purely based off its earnings, which is something I think similar to what we see with Berkshire Hathaway having massive exposure to insurance players out there. It's one of the reasons they have a huge amount of cash. But again, with interest rates coming down, I really thought that could continue to hurt earnings. But here we are, company's still trading at a reasonable valuation, I guess. I don't know. I'm really confused by this one, but I will pass that question off to you when it comes to Manulife. Deteriorating earnings per share, or this is revenue. If we take a look at EPS here, starting to kind of come down a little bit, I'm still really confused, but at least, again, they're purchasing shares back at an astounding rate. They're doing massive share buybacks, which was something people pointed out that for the first time in history, we're seeing like $1 trillion in share buybacks in the S&P 500, a record level of share buybacks, which on the back of decent earnings should continue to bolster revenue growth and all that. You don't want just earnings per share to grow up. It's a bit manipulative when you see earnings going up because share count is going down. So you want to pay attention because sometimes it can be a bit manipulative to say, oh, earnings are growing. But if it's mostly coming from share buybacks, lowering the float of outstanding shares against the revenue that they're able to justify to net income, you do want to keep that in mind. But overall, I've seen great revenue growth across these companies. I've seen great share buybacks. Like I said, I think we're in a weird, perplexing moment in history where we could be in a technical recession, but these companies that sit in this ETF are proving to be the utmost resilient as we start to recover back to all-time highs. And my portfolio for the first time crosses over 400K since I liquidated it to purchase a property. But I love these two ETFs. They're my two favorite, S&P 500, VDY. How do you go wrong here? But I'd love to know what you think and what you're doing in that comment section below.